Hello, good afternoon, and welcome to today's episode of Modesty's Money Masterclass. It's another Monday, another opportunity for us to gather here and share some information, educate ourselves on everything money. Remember, the purpose of this session that I run every Monday is to help improve your relationship with money. So we have come to 45th episode of this Modesty's Money Masterclass, and thanks to all of you who have been part of our journey so far and part of our success story. We really appreciate your support and really appreciate you for tuning in, joining in, watching and listening, and giving us your positive feedbacks, and those constructive ones that are coming too. We also take notice of them. So today on our Modesty's Money Masterclass, we are continuing on the series that we've started, and this is going to be the last of the series on essentials of family finance. This is actually part 6 of the essentials of family finance. So if you haven't been part of it from part 1, I would encourage you to go to my Facebook page, and you can see all the back catalogs of the previous episodes and parts, because this essentials of family finance has really been very useful to a lot of families and a lot of individuals who have been looking for guidance on how to arrange their family finance. So this is just targeted at people who want to arrange their family finance and make sure that their families are financially secure. And we're doing everything possible to educate you on how best to do that and how best to achieve that. So I remain your man, Ikenna Umezudike. I'm the director of Modesty Financial Consultants Limited. We're a financial consulting services company based in Luton, United Kingdom, offering mortgage services, financial consulting and financial advice, and protection advice services. All right, so this is part of what I do to give back to all those wonderful people who are part of my network and who are part of my audience and who are part of my Facebook friends and family and the social media world, wherever you are listening to us. Remember, we've got a lot of our contents posted on YouTube as well, so you can subscribe to my YouTube channel. Just search Ikenna Umezudike on YouTube. There are loads and loads of contents on my YouTube channel that you can also go back and watch and listen and learn as well. Okay, so I better get on with it because there is a lot for us to get through today. So on this very last part of the essentials of family finance, we're going to be talking about something very, very vital to arranging that family finance and securing your family's financial future, and to a very large extent your own financial future as well. So we're going to be talking pensions and retirement. Yeah, we're going to be talking pensions and retirement. So very often pensions and retirement are people use those words interchangeably out of ignorance anyway, because some people think that pensions and retirement are all the same thing. Well, they are not the same thing. Retirement simply means you have retired from work. You can retire from work without any pension. So pension is just one way of securing your financial future into retirement. So pension and retirement are not the same thing. They are two separate things, right? So there are several ways you can retire, and there are several things you can retire on, and pension is one of them. So we're going to clarify all those, and we're going to give you different options as far as pensions are concerned. Hi, Oluwaseun, good afternoon. Thanks for coming on, brother. So what's a pension? Basically, pension is a fund in which you make payments during your active working years, your active employment years. You make payments into that pot. We call it a pension pot or a fund, right? You make regular payments into that fund to build up that fund and to build up that pot. And then when you retire, or at the age when you are eligible to access it, you can draw down on those funds that you have built up over the years, and you can draw down on those funds in different ways. So we're going to come to the point where we're going to talk about how you can draw down on your pension, or the possible options available to you for your pension drawdowns. Now there are two very basic major stages in your pension, right? We call it the accumulation stage and the decumulation stage. Basically, the accumulation stage is when you are building that pension up. that time when you are, consistently contributing into your pension pot, whether at your workplace or into a private pension, or in any other form that you are paying into a pot you call a pension pot. That's the accumulation stage. It can even be just a savings account that you've set aside, or it can even be maybe an ISA that you've set aside and say, this is my pension, I'm going to be paying money into it. So it doesn't have to be an organized pension fund or kind of an institutionalized pension fund. Your pension can take any form. Okay, so there is an accumulation stage and there is a decumulation. That accumulation stage is that time when you are building that fund up. The decumulation stage is when you have built the fund up and maybe you have retired or you have reached the age where you can access that fund, and then you begin to draw down on that fund. That's when we call it the decumulation stage. So those are the two major stages in your retirement or even your pension planning and arrangements. So, and bulk of what we are going to be discussing today will be based on these two stages, the accumulation stage and the decumulation stage, because there are two major stages in terms of pension. So there are three main types of pension I want to talk to you about today. One of them is the state pension. If you live in the UK, we know what the state pension is in the UK, but I'm just going to enlighten you a little bit more about that, or just highlight it. Remember, this session is not targeted at talking about everything pension, because to be honest with you, if we start talking about pension, we can talk about pension the whole day. It's such a vast area to talk about. So I'm just going to pick up a few things that are relevant to what we're talking about, and I'm going to bring that to your notice and to your knowledge. Okay, so it's not an all-encompassing session about pensions, but we're just going to discuss what we feel is relevant for this particular session. So the three main types of pensions I want to talk to you about today is, first of all, the state pension. In the UK, the state pension is paid by the government depending on your national insurance contributions, and it's a secure income for life, and it increases by at least the annual inflation rate. So when you are working, all those NI deductions that your employers are making before they pay you your wages, that's you building up your state pension. And then you keep contributing. If you are self-employed, there are class 2 and class 4 national insurance contributions that are payable by self-employed people as well. So state pension is available to both those who were fully employed and those who are self-employed, depending on how long you contributed and how long you made your national insurance contributions. So the national insurance contributions is the contribution you are making towards your state pension, same as you're making into your pension pot where you are working. So those national insurance deductions are things that are securing your financial future at the state level when you retire, and the government pays you that income for life. For as long as you are alive and as long as you're eligible for the state pension, the government pays it to you for the rest of your life. Okay, so we're going to talk more on the state pension. Now, that state pension is based on your national insurance contribution, like we've said. When you make your national insurance contribution, you are building up. That's the accumulation stage for your state pension. And during your working life, that's where you make that national insurance contribution. So there's a new flat rate that was introduced in April 2016 when the whole pension thing was reformed. The pension reform that took place in 2015-16 basically took care of a lot of things, and it kind of rejigged the pension system a lot. So it introduced a flat rate for pension payment, and for 2020-21 the new state pension flat rate is £175.20 per week. So as long as you are eligible for the state pension, you are eligible for £175.20 per week at least for the state pension. So in a household or in a family, if the husband and the wife worked throughout their working life and they made national insurance contributions, as long as both of them are eligible for that, they are going to get paid that flat rate, okay, of £175.20 a week. So I'm sure some people are already like asking themselves, what? 175 quid a week? What am I gonna do with that? You see? So those are the real questions that we want you to be asking while you are listening to this session, because it's just bringing, just in case you are relying on the state pension, just saying, well, I don't need to do anything because when I get old, the state looks after me. That's what the state is offering you, £175.20 a week. But then, if you have built up entitlements in your national insurance contribution under the additional state pension, under the that is before April 2016, if you have built up entitlements for yourself before the April 2016, you might get more than the flat rate, under the additional state pension scheme or second state pension scheme. But then there were people who were contracted out of that second state pension. So you might have heard of the, for a lot of pension scams that happened then, where people were saying, oh, listen, you don't have to pay anything extra or build any second state pension extra. You can contract out so that you just pay the basic NI contribution and be entitled to the basic state pension when you retire. That extra thing you are building up, bring it and let's put it somewhere else for you where you get much higher returns for your money. So instead of getting the additional state pension, which is the second state pension, you will now get something that is even more lucrative. And they used to quote a lot of figures for people based on unverifiable and unverified market statistics, that you're going to be earning this much. That you're going to be better off basically than you're going to be better off contracting out of the second state pension than being in it if you invest this money with us. And a lot of people bought into it, trusting those advisors and trusting all those, and then moving their funds into that other investment scheme. And at the time, moving out into that into that state second pension scheme, and they contracted out of it and decided to invest that money elsewhere. A lot of them, if we might say, ended in disappointment because the investment didn't turn out to be what they were promised. At the end of the day, they were not told the real situation of things, that look, this is going to expose your investment to market volatility, and you may not get back exactly what you're expecting. It depends on the performance of the market. Some people thought that, oh, these returns are kind of guaranteed and we're better off with that, and then they ended up being worse off than being in the staying in the second state pension scheme. So if you contracted out of that additional state pension, you might get less than that flat rate, basically, when the time comes for the state to pay you that state pension. But to qualify for the full state pension, what you need to qualify is at least 35 years, 35 qualifying years of national insurance contribution. Now, those 35 qualifying years don't have to be consecutive. It could be spread out across different stages of your employment, because it's not possible for everybody to be employed consecutive for 35 years. Some people might have had employment breaks in between. So as long as your qualifying years of national contribution comes up to 35 years, it qualifies you for the full state pension. But for any state pension at all, for you to be qualified for any state pension at all, you have to have at least 10 qualifying years of national insurance contribution for you to be qualified for the most basic part of state pension at all. Okay. Now that's state pension. The other type of pension I want to talk to you about is what we call the defined benefit. We call it the DB pension. So the defined benefits pension is very common among people who work in a large company or in the public sector. This is a salary-based scheme. It is based on the salary that you were earning, and it secures your income for life. So on a defined benefits pension scheme, it's defined by how much you were earning before you retired. or how long you were in the scheme. So how long you've been part of the scheme and how much you were earning determines what you get in that pension. So if it's based on your final salary, the final salary scheme, so there are two schemes in this defined benefits pension. There's the final salary scheme, and then there is the average salary scheme. So the final salary scheme pays out based on your final salary at the time you retire or the time you left the scheme. So if you were employed in this huge corporation, it's very common it's very common among large corporations or people who work in the public sector. So basically your employer is guaranteeing you an income for the rest of your life, right? As long as you're qualified for it. So at the time you're leaving the company, if it's a final salary scheme, they will work out your payment, your lifetime pension, based on how much you were earning at the time you were retiring or at the time you were leaving the scheme. Okay? And what your employer does is that they now guarantee you income for life. How good is that? I mean, people who were contracted out of this defined benefit scheme lost out big time, seriously, because some people were actually contracted out of this defined benefit scheme on the promise of saying, oh, look, you're going to be better off here. Move it into this investment because your investment could just skyrocket by the time you retire and you'll be entitled to a lot more money. But it doesn't come more secure than this. For a final salary scheme where your employer says, for the rest of your life, we're going to pay you this much in pension based on how much you have. It might be a percentage. It might be based on a percentage of what you were earning. That's your final salary. Say if it's a 70% basis, you might say, okay, if you retired on £60,000 a year, we guarantee to pay you 70% of your final salary at the time you left the company in pension for the rest of your life every year. So for the rest of your life, you're guaranteed at least £42,000 income every year, based on how much you're earning. So there is also the career average scheme. The career average scheme pays out based on the average of your pay while you were working or while you were in that organization or at the time you left the scheme or while you were a member of the scheme. So they average out what your average pay has been while you were within the company or while you were within the scheme, and they work out your income for life based on that average. So what happens is that this scheme has proven to be too expensive for a lot of companies and a lot of organizations, and they are kind of now moving away from that, because that's why a lot of companies have experienced a huge pension black hole in their finances, because this proved to be somehow unsustainable, because folks were living a lot longer. people are living a lot longer than they used to live now. So imagine if somebody retired from your company, then say at the age of 60, that was retirement, and they retired at the age of 60, and they lived up to the age of 100. So for 40 years of their life, you are funding their lifestyle based on what they were earning when they retired. So people are living a lot longer these days, and a lot of companies are now moving away from this defined benefit kind of scheme and moving into the defined contribution pension scheme, which is the next type of pension I'm going to discuss about. So it's proving a lot expensive. So it's not very common now to find a defined benefit pension scheme. The more common one now is the one I'm going to discuss now, which is a defined contribution pension. So the defined contribution pension now, this kind of pension scheme enables you to be able to build up a pension pot. And that pension pot you have built up, it's from that pension pot that you can now draw income from it when you retire. When you cut down or when you stop working, that's when you can now draw down from that income. So from that pot that you'll be contributing into, yourself and your employer will be contributing to that pot. The pension regulation in this country now mandates every employer to be paid to set up a pension scheme where people are opted into the pension scheme, but that they can decide to opt out of the pension scheme. So it becomes mandatory for every employer to set up a pension scheme, and as long as you agree to be part of that scheme, the employer is under obligation to allow you to be part of that scheme. And depending on how much you're earning, your employer is also obliged to pay into that pot, while you also pay into that pot as well. So the pension deductions that are being made from your pension, your employer is either matching them to a certain extent or paying some part of that as well. Plus, the government is giving you 20%. So, for example, if you want to make a contribution of £4,000 into a pension pot in a year, what you need to pay into that pot actually is £3,200, because the government pays in the extra £800. That's free money. That is free money. If you have access, that's government basically, giving away free 20% in the form of tax relief, right? So you get a 20% tax relief on your pension. The government makes that contribution to you, that fund is tax-free. So why wouldn't you want to take advantage of that? Hi, Linda. Good afternoon. Thanks for coming on. So if the government is contributing to your pension, you are contributing, and your employer is contributing, why would you not want to be part of that? So now, for the defined contribution pension scheme, you have to be at least age 55 to be able to access it. Because of the pension freedom that was introduced in 2016, people can now access their pensions earlier than they used to. So from the age of 55, you can have access to your pension. And usually, to have access to that pension, you can usually withdraw up to 25% of it tax-free. Yeah? You can usually withdraw up to 25% of that pension pot tax-free. You can withdraw everything, but the tax-free portion is 25% of it. After 25%, the rest, if you withdraw from it, it's going to be taxed at, I think, about 45% rates of tax. Now, there are a few things that your pension growth or your pension pot depends on in terms of the growth of your pension pot. Number one, it depends on the level of charges on the fund. So if you have the option of choosing where to set up your pension pot or your pension fund, please pay attention to the charges. Charges are very, very critical in deciding where you pitch your tent when it comes to pension pots. There are lots of platforms with a lot of hidden charges. You've got to be clear on how much they are charging, because for everything you are charged and for every charge you pay on any platform that you invest in your pension pot, that is money denied you for your retirement. So charges are a very, very vital component of deciding where to invest and where to pitch your tent when it comes to your pension investments and your pension fund. The other thing that determines the growth of your pension pot is how well your investment performs. So in a defined contribution setup, that money you are contributing into that pension pot is being invested. So unlike the defined benefit, when you have guaranteed income for life based on the salary you are earning when you retired or your average salary, this is now based on how well the market performs. So your pension is dependent on market volatility and market performance. If the market performs well, if your investment performs well, then you have good money in your pension pot when you retire. If the market doesn't perform well, your pension pot could go down as well. So it's all subject to market performance and economic factors. The other thing that affects the growth of your pension pot then is your level of contribution. That is how much you are contributing and how much your employer is putting in there as well. That is also what will determine how your pension grows. Because obviously, someone who, for example, if you're setting up a private pension or personal pension for yourself and you're paying in £500 every month into that pension pot, your fund will obviously grow faster and quicker than somebody who is paying in £100. By the time the both of you retire, for the same amount of years of contribution, the difference is going to be based on how much each person has contributed into that pot. So the more you contribute and the more your employer puts in, the the fatter your pension pot becomes, obviously, because those when you have more funds at your disposal, when investors have more funds at their disposal, their buying power increases. It exposes them to more opportunities to invest for you and on your behalf, and it gives your fund, your pot, some kind of leverage against those who are really not up to that level of contribution. So it all depends on the charges. It depends on how well your investment performs, and it depends on your level of contribution for a defined contribution pension scheme. Hi, good afternoon. Thanks for coming on, Simon. I can see you. Well done, bro. So for defined contribution pension schemes, it could be in the form of workplace pension, it could be in form of personal pension, it could be in form of stakeholder pension schemes. So these are all different kinds of defined contribution pension schemes. Whether it's a workplace or personal or stakeholder pension schemes, the main consideration is the structure of that pension. As long as it's based on market forces and based on your contribution into the pot, it's a defined contribution. So you can see the difference between that defined benefit and defined contribution. Okay, so that's the difference between defined benefit and defined contribution. It depends on your contribution rather than the salary at the time you were retiring. Okay, now to saving for retirement. Let's talk about, I've mentioned that retirement and pensions are not the same. So we've talked about pensions because pension is just a way, one of the ways of saving for retirement. But let's just talk about retirement in general and saving for retirement. With the flat rates of state pension at £175.20 per week, it's obvious that to some people, this cannot sustain them. Think about your lifestyle. Think about what you want to look like when you retire, because it's something you need to sit down and work out. What do I want? What sort of life do I want to live when I retire? The answer to that question will tell you what you need to do and how quickly you need to start doing it. Because if you can envision your retirement and say, okay, well, when I retire, I just want to be traveling around the whole world. I want to see places when I retire. Can you do that on £175.20 a week if the state pension is your only hope? Or that I want to retire to a countryside where I will just, relax in a countryside with some very good mansion, in a countryside, very quiet area, go fishing, have my boat and just retire beside a lake or beside a river where I can take my boat out and go, just envision what you want to do. And then you think, can £175 a week really fund this kind of lifestyle? So it's certain that to some people, it won't be enough, and it cannot be enough. Therefore, they have to do something. So your retirement plan should be based on how you want to retire. And to be honest with you, some people want to retire on less than the lifestyle and their standard of living now. Because to some people, they just want, okay, now it's costing me this much to survive. When I retire, I just want to retire into a one-bed flat. Just me and my wife, just me and my spouse. We just want to live in a one-bed flat, our small one-bed flat. We'll live there privately on our own and just basically downsize. They might be living in a 4-bedroom house at the time they're making this plan. They're saying, we want to really downsize and crush down our standard of living to the very barest minimum. As long as we have each other, we have everything. Come on. To some people, that's what they want, and that's how. So as long as we have each other, we have everything. We just need a roof over our head. Even if it's a 1-bedroom flat, we don't care. We just sit in there. We make a cup of tea every morning. As long as we have our TV license and we watch BBC News all day, watch ITV, and just that basically, it doesn't matter. That might be what they want. And for people like that, for someone like that, £175.20 a week might even be more than enough, because they might not even spend of that amount every week. So it's about what you want your retirement to look like, yourself and your spouse or your partner and your family, right? What will retirement look like for you? That's what is going to spur you on to do whatever you want to. That's the motive behind whatever kind of retirement planning you are drawing. So you can work out your standard of living now and then start working towards it, based on what you are envisioning. So your pension pot contribution is one way of saving for retirement. Yeah? There are other ways of saving for retirement, which include things like ISA, which I have mentioned before. ISA is another way of saving for retirement. You might decide to. There are different kinds of ISAs. There is the normal ISA. There is the stocks and shares ISA. There is the lifetime ISA. The lifetime ISA, for example, is targeted at young people under the age of 40. If you're under the age of 40, you can open a lifetime ISA and start saving into it. And you can only access it when you're age 60, or if you want to use it to buy a property. And the government is going to give you 25% bonus whenever you want to access that lifetime ISA. Cool money again from the government. The idea is the government wants to use the lifetime ISA to encourage young people to start saving, and start saving towards their retirement, or start saving towards the purchase of a home. So for those who have missed out on the help to buy ISA, the lifetime ISA is another opportunity for you to take advantage of government free 25% if you want to use it to buy a property. Those are the two purposes for which lifetime ISA was introduced by the government, to encourage young people to save towards either retirement or towards buying a property. Okay, so pension and ISAs are ways of saving towards retirement. You can also do property investments. Properties investments are another way of building your retirement income for yourself. You can be buying a lot of properties, and that generates you income, or that even appreciates over time. By the time you retire, those properties might be worth something considerable for you to sell and buy other kinds of retirement income with that, or sell them and start drawing the fund down in lump sum until it finishes or before you die. Hi, Joy. Good afternoon. Thanks for coming on. Okay, so mutual funds and other kinds of investments are places you can also put funds in towards. So whatever you are building, whatever kind of fund or pot that you are building, or asset that you are building, with the aim of taking advantage of it when you are out of work, when you retire from work, outside of your active employment years, that is your retirement plan. So when exactly is the best time to start saving for retirement? Now, depending on your circumstances, okay, when you want to start saving for retirement, you can start saving at any time, but preferably at a young age, because the advantages are more when you start saving for retirement at a young age. Imagine if you're, say, 25 and you've started working at the age of 25, and from then on you started building your pension pot. By the time you are 60, you would have saved into pension pot for 35 years. Trust me, the compounding effect of the investment value of that savings every year for 35 years, you will not believe what that would amount to in 35 years. You've got a head start ahead of a lot of people, and you've got a head start. If somebody else started saving at the age of 40 for their retirement, you already have 15 years head start ahead of somebody who started saving at the age of 40 into their pension pot, started building their pension pot at the age of 40. So imagine what your fund had done in 15 years already before this person even started. So the best time to start saving for retirement is at a young age, and immediately you start earning. The moment you start earning money, start saving towards retirement, start building a pension pot the moment you start earning, because the earlier you start, the better. But that's why I said, depending on your circumstance, some people start late in life And we are not blaming them. It's not a blame game we are playing here. We're not trying to, guilt trip anyone who didn't start saving early enough. If you didn't start saving early enough, those past years, they are gone, they are gone. You cannot rewind the hands of time to go back to becoming 25 again. You might wish, oh, if I knew then what I now know, that Ikenna is telling me this, I would have started doing that. Forget about the guilt tripping. We're not guilt tripping you. We're not trying to make you feel like you've wasted years. You can start right now. Okay, after listening to this particular session, you can start right now. You can go and set up, a retirement plan or a pension scheme, or however you wish to start it. The important thing is for you to start doing something towards retirement. So the best time to start is the moment you start earning. As soon as and as long as you have something you're doing that is generating you income, start putting something aside for when your strength will fail you, that you can no longer work as hard as you used to work now. So, and that's why the lifetime ISA should be taken advantage. If you're under 40, if you're under the age of 40, living in the UK, take advantage of the lifetime ISA and start paying into it whatever you can, because the government is boosting that by 25%. And I can't think of any other pension administrator or fund that gives you 25% bonus just like that, for saving into your pension scheme, which is still doing well for you. Okay, so when you start later in life, you just have to be more aggressive about it. You just have to be contributing a lot more to make up for the lost times. That's the only thing you've got to do. Yes, you've lost some years. Now that you've known and you've started, start contributing a lot more into your pension pot so that you can make up for lost times and build that pension pot as quickly as possible. Now, I took a look at some statistics about savings in the UK and the age brackets of people who are saving. I'm just going to take the youngest age bracket and the oldest age bracket on that statistics and give you an indication of people's attitude towards savings alone. Talk more of pension, because pension is a kind of saving. That's basically what it is. But then that saving is now being invested. Okay, so 18 to 24-year-olds make up 5% of the savings inquiries in the UK. 18 to 24-year-olds. Meanwhile, over 65s make up 30% of the total savings inquiries in the UK. So that statistics, there are other age brackets in between, but I just wanted to take the youngest and the oldest age bracket there to draw an analogy on this. So in that statistics, it simply shows that the older the age bracket, the more the percentage and the proportion of savings inquiries increase. So it looks like the older people get, the more they begin to understand the advantages and the value of savings and having something in savings. And then the over 65s had the highest proportion of savings inquiries. You see, so that's why financial education is very, very, very important. And do not underrate what you are doing now. And do not take any knowledge you are gaining from this program for granted. Because trust me, you are already ahead of a lot of people who do not know what you know now. And it will only be useful to you if you take action based on that. You can watch as many of my videos as you want. You can listen to as many of my sessions as you want. Unless you take action on those bases, it's useless. And you have no advantage. You are not better than the person who did not even listen to it. But at least the edge you have is that you now have the knowledge, you have the information, and you know what you need to do now to get started. Okay? Unfortunately, in our schools these days, financial education is not even on the curriculum. That's why our young people come out of schools and colleges and they have absolutely no idea what to do with their financial lives. That's why that percentage, 18 to 24 years, have the least proportion of savings inquiries made in the UK. Because at that age, they don't think about anything else except consuming. consumption, consumption, consumption. Everybody just want to, whatever goes into their pockets goes out straight away, because they want to use the latest phones, wear the latest clothes and shoes, carry the latest bags, drive the latest cars, have the latest wristwatches, go partying and party hard and show off as much as possible that, I'm richer than you am, even though I'm not even rich, So, but if financial education was part of educational curriculum, a lot of our young people will come out of college or out of school knowing exactly in what direction to channel their financial lives. But that's a discussion for another day. So that's why what we are doing is to educate people on this financial stuff, just to help you improve your relationship with money. Okay, so how do you save for retirement? I have talked about pensions. So as described earlier, you can build up your pension pot contribution, or you can, either by the direct benefits or by the direct contribution scheme. Okay, pension is one way to save for retirement. ISAs are another way to save for retirement. ISAs are more flexible than pensions because you can access ISAs. Anyway, sorry, for those who don't know what ISAs means, it simply means individual savings account. Okay, so what this session is, interactions are very welcome. So when you are listening in, if there is anything you don't understand when I'm saying stuff, just type a comment, type a question in the comment section, ask me any question. I can stop and answer that question, and then we'll carry on. Because it makes no sense if I'm saying all these things and you don't understand what I'm saying. So if you don't understand anything, if you have any question, just type it in the comment section, or if you have any comments to make while we're discussing these things, feel free to interact with me. This is not a classroom, it's an interactive session, so interactions are very welcome, okay, as long as they are in line with what we're discussing. Now, ISAs are another way to save for retirement. It's called individual savings account. Okay, so you have an allowance every year of £20,000 depending on the ISA you're choosing. So you can choose to save for retirement in an ISA. It's more flexible than pensions because you can access it anytime you want. But pensions, you can only access them from the age of 55 and above. But the pensions have more potentials to, it has a better structure in terms of retirement planning than ISAs. Properties are another way of saving for retirement. You can invest in properties either for growth or for income. So if your aim is to be taking income from your property investment, you might want to choose to invest in areas where income potentials and yields are higher. If your intention is to build up wealth in property, not really income, but by the time you retire, you want those properties to be worth a lot more than they were when you bought them. You might want to consider investing in areas where there is more growth, where are more growth potentials, where property prices appreciate more, but the yields are less. So if you are willing to take a less yield and a higher growth, then it will now that's what will advise of where you are going to invest. That is what will determine where you choose to invest and how you choose to invest in properties, as in your strategies. Stocks and shares are another way of saving for retirement. You can buy a stock, at a young age of 30 and hold it for 20, 25 years. By the time you're 55, that stock would have appreciated a lot. And on the way, you would have been buying a lot more stocks on the way. If stocks are your cup of tea, you can choose to be investing in stocks all through your life and just say, I'm buying these stocks and I'm buying them and I'm holding them because they are my Hi Adeola, good afternoon, thanks for coming on. I'm investing in stocks because they are my bread and butter. That's how I want to build my pension or my retirement savings. Okay, there are other asset classes like precious metals like gold and silver that you can also buy and hold for a retirement. When you retire, you can liquidate those assets and use them to fund your retirement lifestyle. So those are different ways that you can save for retirement. So pension drawdowns. Now that we've been focusing on the accumulation side of pension. Hi Faikemi, good afternoon. Thanks for coming on. We've been focusing on the accumulation side of pensions and retirement savings. Now let's venture a little bit into the decumulation. So the decumulation stage is basically now that you have built up that pot, you have built up that retirement pot and that retirement savings. And how do you decumulate? How now do you begin to draw it down? So decumulation is basically now drawing down on that pension and taking from that thing you have been building for years to fund your personal lifestyle, to fund your lifestyle, to fund your ambition, that thing you've been thinking of, you've been dreaming of, you know, that's your dream retirement. That time has come. How can you then access all those things that you have been denying yourself for a number of years? Now I'm going to discuss 4 possible ways that you can do that, and I'm going to use pensions for the purpose of this session. We're going to use pensions. You know, you can attribute that to every other kind of retirement build up that I mentioned, like ISAs and properties and stocks and shares and all that. Those are ways you can also build up, but I'm going to use pensions to describe the decumulation and how it works. Now, 4 possible ways you can access your pension or you can decumulate your pension or your retirement funding via pension. Number 1 is lump sum. By virtue of the pension reform that was done, you know, by the Conservatives in 2015-16, it gives you access to your pension fund from the age of 55. So from the age of 55, you can practically draw down every single thing in your pension in lump sum if you want to. So even if you have £500,000 in your pension pot, the moment you clock 55, the government new regulation now says you can have access to everything in your pension pot, all of it if you want. But here is the game. 25% of it is tax-free. Yeah? The remaining 75%, if you choose to draw that down in lump sum as well, the government is going to tax you, and they're going to tax you heavily on that. Now, depending on other sources of income you have, and you know, working out the tax liability on that is complicated, so you need to seek tax advice on that to work out what the tax liability will be if you choose to, you know, withdraw or to draw down on all of them in one lump sum. But the truth of the matter is that you can, and the first 25% is tax-free, but the remaining 75% is taxed, and the tax is not funny. Okay, so I'll just leave it here. I'll just leave it here. So you go and seek tax advice if you intend to withdraw everything. So, but you need to know that you can access all of it from the age of 55. Now you will need to obtain financial advice, obviously, to do that. Pension fund managers can't just give you, say, £100,000 of your income that you have built up. Say, okay, there you go, because you have no. You need to evidence that you have taken financial advice, and that financial advice has okayed your purpose of wanting to withdraw the whole of that fund. Because the financial advisor will have to sit down with you and know exactly why you want to access the whole of those funds, what do you want to do with all of it, and when they have gone through all that process with you and they think it's good enough for you, they can now okay that. You can take that piece of financial advice evidence to the pension fund manager and say, hey, here you go, my financial advisor said it's okay, I can withdraw everything. And then they can give you that. What that does for the pension fund manager is that it covers their back, because they are a highly regulated industry. It covers their back for when the government comes asking them, why did you give this guy all of this money without any financial advice, without anybody warning him of the implications? Because you can take the £100,000 and go blow it tomorrow, and then you become very broke. And the government and the system hates it when the liability is now on them to look after you, because then you become government property. You become government liability. They have to look after you. So it's a cost on the side of the government. So the government are more comfortable when you are comfortable. So they would rather you become comfortable in retirement than when you are uncomfortable and then the government is faced with that responsibility and the task of looking after you. So you need that financial advice. This is only possible for defined contribution scheme anyway. So this is not applicable to defined benefit scheme where it's a final salary or average pay scheme. This is only applicable to defined contribution scheme like we've described before. Number 2 way of drawing down on your pension is the income, is what we call the income drawdown or the income withdrawal option. Now this option, again available to defined contribution scheme pensions, gives you the option of drawing down on your income on a regular basis. So you know, if you decide to invest your fund, right, in an investment in a pension pot and with a pension fund manager, you can now, when you retire or when you are at the age of accessing that particular, you can choose to start drawing down on that fund and taking income from that investment on a regular basis. Okay, because it's your money. So once the law says yes, you can now access it, you can choose to be withdrawing that money based on what that investment pot holds for you as a retirement income. So if you choose to be withdrawing, say, £500 from it, £6,000 a year every month, you can be withdrawing because it's your money. Meanwhile, as you are doing that, that money, that fund is still being invested. While you are drawing on it, while you are drawing down on it, the money is still being invested. So you can take regular income from your pension fund while you still allow that pension fund to grow. Now, note that your pension fund is subject to market volatility, so it could go up or it could go down. So there's a possibility that that fund could be growing while you are drawing down on it, or it could be falling while you are still drawing down on it. So you will still have to work, or you might still have to work with a financial advisor to discuss your pension drawdown plan. Like, how much do I need to be drawing down? How can I invest this fund to give me this amount of regular income when I want it? Hi, Sunday. Good afternoon. Thanks for coming on. So, and there's no limits on how much you can withdraw from your pension fund each year. So you can draw down everything in 1 year and then go broke the next year. There's no limit to that, right? But you need to fund, you need that fund to continue to grow each year so it can be making up for the withdrawals that you're making from that fund. So you need to keep the fund growing and the fund invested. So that's number 2 way of drawing down. Number 3 is what we describe as flexi drawdown. Now, on the flexi drawdown, it gives you a flexible way of accessing your pension. You can take a combination of lump sum and a combination of regular income, in the flexi drawdown. So it's a combination of lump sum and income drawdown, basically. So you can take part of the money in lump sum, and then the remaining, so if you decide to take the whole 25%, which is tax-free in lump sum, you can do that. And then the remaining 75%, you invest it, and then you are drawing down on that 75% on a regular income basis. So the invested income that you choose to draw down from becomes the one that is left after you've taken the lump sum. But then, even if you don't want to take the whole 25% in one go, you can actually take the 25% in chunks, right? But as far as the regulation is concerned, the tax liability is concerned, whether you take them in chunks or in one lump sum, the first 25% remains tax-free, however you choose to take it. You can even choose to take the whole fund in income. If you choose to take the whole fund in income without taking any lump sum, the free 25%, the tax-free 25% still applies. So that will still apply when you are taking that, when you are drawing down on that income. But then that part that you are taking as income, as a regular income, the moment you've exceeded your 25% tax-free, that other part is now calculated as your income and is taxable because it becomes an income. And as it's an income, the government is going to factor in other sources of income that you have. Maybe that pension is one part of your income. You might have stocks and shares, you might have properties, you might have even a small job that you do part-time, that earns you. So when they factor in every source of income you have, then they can decide, what proportion of taxation is levied on that income that you are drawing from your pension. So that is a taxable income, for your information. So you can choose to use the remaining sum after the lump sum to buy annuity. So annuity is the next one we're going to discuss. So number 4 is annuity. Annuity is another way of decumulating your pension or drawing down on your pension. So what's an annuity? Annuity is an exchange where you exchange your pension lump sum for regular payments with the annuity provider. So usually it's an insurance company. Insurance companies, they're the ones who sell annuities. So what you do is that for you exchange your lump sum pension for regular payments for the rest of your life or for a fixed term. So it could be it could be a lifetime annuity or it could be a fixed term annuity. Those are the two types of annuities that's very common that we can discuss today. So you can decide to exchange that. So if your pension pot, for example, is say £200,000 and you want to buy an annuity, you can approach an insurance company and say, I've got £200,000 and I'm scared of running out of money, when I am old. So I want to buy an annuity. How much can you take this, my £200,000, and then be giving me a guaranteed income for the rest of my life in form of an annuity? The insurance company will take that, factor in your age, your employment status, where you intend to live and all. When they factor in all those, they will now give you a rate, an annuity rate. So if you agree on that rate, they will take that lump sum and then they will be giving you a regular income in return for that lump sum. Okay, that's annuity. So for some people, they buy annuity because they are scared of running out of money when they are old. So they just say, okay, I don't want to invest this fund because I don't want to lose it. I don't want to invest this fund because I don't trust the market. I don't want to put it into property because I don't have the time to manage property. I just want an easy life. Insurance company, take £200,000. How much are you going to be giving me for the rest of my life? And they'll work out what that will give you. If you're happy with that sum, fine. If not, you can explore other options. So an annuity is an insurance contract that it ensures you against living for too long. So if you live up to say the age of 100 or over 100, you might find the annuity useful to you because at that time maybe there is nothing better than that. But then if you don't live that long, you might realize that the annuity you bought, you actually did not enjoy your pension. You actually did not enjoy your pension before you died. The money, the pot of money was there, but you were just receiving trickles of it because you weren't too sure of when you're going to die. So if you die younger than you expected to die, it's your loss. But then your beneficiaries can pick up from where you start and spend the money on your behalf. Yeah. So if you live too long, it's value for money, right? But then if you don't live that long, you might find out that you did not really enjoy life as you wanted to enjoy it. But then those are things that you need to find a balance in between. Now, lifetime annuities will pay you or your nominated beneficiaries the payment, regular payments at agreed intervals for the for the rest of your life. That's what lifetime annuities do. And then for fixed term annuities, for example, if you have a fixed term annuity of 5 to 10 years, for that period that you have that fixed term annuity, you have payments made to you on regular basis for that fixed period. And the fixed term annuities have what we call maturity value. So at the end of that fixed term, the maturity value of that annuity is you will now receive it in lump sum, and then you can use it to either buy another kind of retirement income or invest it somewhere else. So that's fixed term. So when the term ends, you can now take the maturity value and buy yourself another retirement income if you wish. Annuity income is taxed as a normal income. That's how annuity income is treated. Okay, folks, this is how much time could allow us today, but I promise you next Monday, we are going to bring you the concluding part of this pensions and retirement financial education as it relates to family finance. And next week, we're going to now focus on pension inheritance. We're going to talk more about how your relatives or your spouses or people who are related to you can actually inherit your pension and in what form and how are they taxed and the tax treatment of all those. We're going to talk about all that next week. I told you that pension is a very, very huge and vast area to talk about. So what we are just speaking here are just the basic things that you need to know. If we decide to go deep into discussing pensions and how retirement works and the different angles to it, it's going to take us the whole day. But I hope I've been able to pick up those things that are useful to you and that you can benefit from and you can start acting on immediately. And then by next week, hi, you're very welcome, Faikemi. I really appreciate that. So by next week, we're going to talk about pension inheritance and how that's all done. I hope you take action from today and I hope you put all this into practice. Before then, I'll see you again on Wednesday when we come for Modesty's Mortgage Masterclass. God bless you. Take care and stay safe.